So pleasure to be here with you today at the Sun Valley Forum. I've been very excited to hear some of the other things we've had on the other days, particularly the conversation about framing, because I think even in the investing community, what people listen to are stories. And the stories that we at Carbon Tracker tell are stories about using numbers and stories about how the energy transition does pose a financial risk to a lot of firms that are continuing in the business as usual approach to the fossil fuel economy. So I'm going to walk a little bit through that today. And I say long-term decarbonization in the age of short-termism simply because we've seen some interest from large asset managers and others to decarbonize, but at the same time this backlash seems to be having some effect. But we need to look at the sort of fundamental trends. So here what we have, right, is a comparison on these charts. You don't need all the details. Proved reserves, I just want to say, that's things in the ground that we think are economically and geologically recoverable. So we think it's reasonable economically. That's what the markets are being told, that we're going to recover those proved reserves. Okay? Of that, some chunk is listed. So it's sitting in publicly traded companies. And that amount is basically equivalent to our remaining carbon budget. Now, something here is going to give. We know that. We are not going to burn everything that we have here. And one of the questions we ask is how, but how fast is this going to happen? Well, I've put up here the year in which we expend the carbon budget. And if you're not familiar with these scenarios, the IEA net zero is one that says we're going to get to about 1.6 degrees centigrade stabilization in the atmosphere, whereas some of these others, the stated policies and sustainable development, aren't as rigorous. So the question you should be asking is, how come the carbon budget is basically, we're going to exhaust it in the next 5 to 6 years under all these scenarios? And the reason is we can't turn the ship fast enough, okay? In the net zero scenario, you have longer term, more rapid declines in carbon and under those expectations, and you have a massive increase in carbon sequestration. But ultimately, it's like we're heading around a hairpin turn at 50 miles an hour on a mountain. We are not going to make that turn right now. We are going to have to make corrections later. And you can get this more information. You can see there's options here at fossilfuelregistry.org, which is a project of ours. This is just another way of thinking about this. So we look and trying to decide, well, if we are not going to use all this carbon, who's it going to impact? And so we use what we call a least cost methodology, looking at the break-even costs for companies to lift oil, gas, or coal from the ground. And on the assumption that those who have the lowest costs are going to be the most likely to prevail in competition in the future. But you can see under any scenarios of 1.65 degree, 2.7 or greater, there are volumes that these listed companies have that are probably going to be uneconomic. What that tells you is that down the road, there is some financial risk. If they're investing in these projects, which are multi-decade projects, but we end up riding the ship on this, those projects could be exposed to lower returns. And you could say, well, Rob, that's your saying that, but what do the companies say? Well, here's what the companies say, actually. So Exxon's investors were asked it to say, okay, well, what happens in a net zero scenario to your business? And you can see on the left-hand side, they're talking about their traditional oil and gas business, essentially the dark blue. It goes away by 2050. Their capital expenditures move from 2020 rapidly down to almost nothing by 2050 in their traditional oil and gas business. Meanwhile, a business they don't have really today in any material amount, the low carbon solutions business, would have to grow rapidly. It would have to comprise 50% by 2030. That's just 7 years from now of their capital expenditures. So what they're saying is this would be a radical transition for us. This shows real exposure. The problem is this is not the business model that they're undertaking. They're undertaking more of business as usual. We look a little bit at this, and I'm going to blaze through this because we're going to talk about disclosure in a second. But there are lots of rules around disclosure of, for example, the assumptions that companies make on a forward-looking basis in their financial statements, right? So if you want to identify whether your assets are impaired, you need to have a sense of what the cash flows are going to be. You need to know the prices, the costs. Those guesses about the future get embedded in our accounts. Accounts not just backwards looking. But do companies even disclose those assumptions as they should? Mostly no. And so this is a survey that we do of the CA100 companies looking at the extent to which they are making those disclosures. I'm going to move through that because I want to talk about this last issue. I've talked a lot about what we have called stranded assets, and that's the risk of investing in assets that aren't going to generate the economic returns that were expected when they're invested in. But there's another side of this. There's stranded liabilities. So every company in the oil and gas business, whether upstream, midstream, or downstream, has asset retirement obligations. That means they can't just leave a well unplugged or a pipeline in the ground unused or a refinery just sitting on the Gulf Coast without having decommissioned it. And those are expensive, okay? In some cases, they're on the balance sheet if the company knows when they're going to close a plant. But in many cases, they're not. So investors don't even have any understanding of what they are. And when they're on the balance sheet, they're presented on a discounted basis. So if you're going to spend $1 billion in 2050, it looks much smaller today. So people don't have a clear picture of it. But we've looked at the costs, in this case, of all the oil wells in the United States, onshore only, no other infrastructure. That's a $280 billion price tag. We haven't done the math yet, but our expectation is, from having done some of the preliminary work, we're looking at over $1 trillion of asset retirement obligations in the country, okay? This is not like nuclear. Nuclear companies have to put aside money to pay for these. These are not covered at all. Companies have to take out surety bonds and other things to cover these. We estimate they are about approximately 1% of the cost. So the only place that money is going to come from to deal with this are future cash flows. Now, what's going to happen to future cash flows as we transition away from oil and gas? That's a big problem. So we thought about that and we said, well, let's take a quick look, and it's the last slide I'm going to leave you with, is we said, okay, well, let's look at California. What are the future cash flows? And we had a petroleum engineer look at this. What are the future cash flows from all the oil wells in California? Okay? And what are the costs of decommissioning all of the upstream oil and gas infrastructure in California? And when we looked at that and we looked at liabilities that we could document and others that we couldn't, we included some inflation because our numbers were old and there has been a lot of inflation in the oil field in the last couple of years. And what we're really looking at is a $15 billion shortfall, okay? And that $15 billion shortfall assumes that you take every penny of the revenue that we would expect, the $6.3 billion over here, and devote it to plugging these wells. But actually, none of that is devoted to plugging the wells. All of that goes to owners, okay, and it is given out to others. It doesn't go to plugging the wells. So we have this real problem. We're not thinking about it. But what happens when people wake up to this? Right? What happens when regulators wake up to this and they say, you know what, we're not going to let the money go out because otherwise these liabilities that are the company's liabilities will go to taxpayers. And so I say all this to say, even though we've seen some kind of move away or apparent move away from these, the fundamental issues and challenges that oil and gas companies face are significant. They will be growing, and these kind of things are going to pop up. And so I would expect that we'll see that pendulum swing backwards. And I'll leave you with that.